Hi students, let's revise CA Final AFM Chapter 3 Advanced Capital Budgeting Decision. Practical question 8. XY Limited has under its consideration a project with an initial investment of 3 probable cash inflow scenarios with their probabilities of occurrence have been estimated as below. So annual cash flow 20,000, probability of 10% and then 30,000 70%, 40,000 20%. As we can see, the cash inflow is least in the 10% probability, so which will be our worst case scenario, and the best case will be 20% and 30,000 will be most likely. And the project life is 5 years and the desired rate of return is 20%. The estimated terminal values for the project assets under the 3 probability alternatives respectively are 0, 20,000 and 30,000. So these are the salvage values. Even for salvage values we have to apply the same probabilities to arrive at the expected salvage value. Then they are asking, you are required to find the probable NPV. So probable NPV is nothing but the expected NPV. So in ICAI solution they have given this big table which we need not prepare, as the annual cash flow is the expected annual cash flow is same for all the years. We can directly go with the annuity factor, so we don't need to put this table. So if we are going with the annuity factor, initial investment will be 1 lakh and then in between cash flows will be 31,000, which is calculated here 20,000 into 0.1, 30,000 into 0.7, 40,000 into 0.2, so 31,000 in between cash flows. Then for salvage value also will be same. Actually this is expected values, and expected salvage value will be 0 in 10% probability, 20,000 in 70% and 30,000 in 20%. So we'll get 20,000. Then PVAF we can take annuity factor, which is 20%. If we take 92,708 for in between cash flows for 5 years, and then for 5th year salvage value, 5th year discount rate 0.4019, 8,038, and we are getting an expected net present value of 746.6, which is same as the IC metal question. So we don't need to put this big table, we can directly go with PVAF. The same case go to the second requirement. In the second requirement they are asking the worst case NPV and best case NPV. Worst case NPV, as we have previously seen, 20,000 10% probability. Same way we can take the annuity factor for 20,000. Then in the worst case the salvage value will be 0, so 0 divided by the discount rate will be 0 only, so don't need to enter, but you have to mention, we have to keep in mind. Then NPV will be 40,000 in the worst case, negative 40,000 in the worst case, and in the best case same here also again we can take the annuity factor. Then the best case is 40,000 and for that salvage value will be 30,000, so we are getting a positive NPV of 31,680. Then they are asking, state the probability occurrence of the worst case if the cash flows are perfectly positively correlated over time. So what is this perfectly positively correlated over time? It is nothing but in our previous questions we have seen the perfectly dependent probability cash flows, so wherein the probability will not change over time. So the whatever for the worst case scenario, the probability it will remain same for the it will remain same throughout the project. So in our case the worst case is 20,000, which the probability is 10%. So the same continues with the project life of 5 years, so it will not change. If the so in the answer, if the cash flows are perfectly dependent, then the low cash flow in the first year will mean a low cash flow in every year. Thus the probability of the worst case occurring is the probability of getting 20,000 net cash flow in year 1 is 10%. Thank you.